Hey guys, I hope you all are doing well. Welcome to the next episode of the Audit Practically series, where we'll be looking at part 2 of Payroll FSLI. So, last time we completed the part 1 where we ended it with net pay tracing. So, there are a few more items for us which are left. So, once we complete them, we will be done with the Payroll FSLI, and that's what we will be doing in the part 2 of the Payroll segment. So last class I had told you guys that I would be explaining about a concept called in-depth validation. So moving on to in-depth validation now. So there are three types of movements in the headcount as we had already seen earlier. So one is the employee addition, one is the employee deletion, and the others are the existing employees who are there throughout the year. So basically, first, if I just come to employee additions, there are basically three things you will be seeing. Or maybe if I have to put it like there are many things you'll be seeing, three are primary. So basically, your offer letter and your appointment letter and your background verification forms are primary. So what is your offer letter? So offer letter is basically a broad document that outlines the terms and conditions of your service, your pay entitlement, and other factors. And what is your appointment letter? In your appointment letter, certain specific clauses wouldn't have been agreed upon in your offer letter earlier, which should be agreed upon in your appointment letter. For example, your date of joining and the other specifics like as to where is your office location. Let's say your company has like 3 4 offices, that may be agreed upon specifically in your appointment letter in case the same was not agreed upon initially in your offer letter. So to be precise or to be very simple, I think your appointment letter is even more specific as against your offer letter, which is a very broad overview. Then your background verification forms. So usually there are companies which have their own HR team to do the background verification, where they actually ask for the previous education certificates, the birth certificates, the PAN card, the Aadhaar card, and other supportings. Or sometimes an external agency might do the background verification process, and they will hand it over to the company HR, who will do the final vetting before going ahead with the decision of recruiting the employee. So these are some documents you'll see, and then there will be an interview basis which the candidate would have obviously been selected. So there would definitely be an interview assessment form basis which the candidate would have been selected, because obviously the interview would have to tick certain boxes before the interview wants to select a particular candidate. That is one thing, and you can obviously see the pay slip for that month, provided the pay is processed for him within the cutoff date. Like we discussed about cutoff date in the previous video, and whether the pay is processed before or after the cutoff date. You can just check that, like if it's processed in the same month itself, assuming that the employee is joined within the cutoff date. You can also check the pay slip for that month as a supporting. And usually what will happen is the employee will usually give a cancel check to the company, evidencing his bank account number and other bank account supportings. So you can also examine that for the new employee to ensure that the employee is actually a real employee, not a bogus one. Next, your employee deletions. So an employee deletion is a scenario where the employee leaves the company. So there are again certain documents which you can verify and compare the pay as per pay as per these documents with the pay as per the pay register which has been last processed to the employees. So there is something called an F&F form. So in your F&F, there will be the ultimate pay that is getting processed to the employee. You can compare whether the gross pay as per your F&F is tying out to what is there in the pay register. You can also see whether the net pay is tying out to what is there in the pay register ultimately. And you can see the resignation letter submitted by the employee. So once the employee submits the resignation letter, the exit formalities would be initiated. Then the company would hand over the relieving letter to the employee. You can also go through that to see that the date of deletion is actually tying out to what is the date of deletion in your headcount movement or in your pay register. You can just check that, and you can also check the no objection certificate which the employees obtained from all the departments from a test of control perspective. You will also see this as a see. You will mostly see the offender form as a part of your test of details, but the other aspects like your NOC, you will focus on them more from a test of controls perspective. Then for the existing employees, so there are existing employees in the company. Let's say there are employees who've been there throughout the year. So for them, they would be having a salary revision during some part of the year. So you can trace back the salary revision that has happened to the employee back to the salary revision letter. So in the salary revision letter, the revised pay structure for the employee would have been outlined in an elaborate manner, and you can ensure whether the gross pay as per that is actually tying out to what is given in the salary revision letter. And you can also see the pay slip for the month from which the salary revision has actually taken effect. So that is something you can do again. And another thing which is very important, which I would like to say, is the separate validation is required for gross pay components that are not routed via offer letter. So what do I mean by this? So let us say we talked about employee addition. So let us say an employee is joining. So let us say an employee Mr. A is joining. So just give me a moment, guys. I think the screen is just gone off. Just give me a moment. Uh, yeah, I think it's back now. No, just a moment. Just give me a moment, guys. I think it's just loading. Yep. Yep. Sorry for the inconvenience, guys. So I think the screen is perfectly visible now. So as I was talking about the employee additions initially, so you would be tracing it to the offer letter. You would trace the pay components as per your gross pay to back to your offer letter. So there are some components which should not be routed through your offer letter. Like let's say you are a person from the sales team who has been recruited in the company, you would be given a sales bonus or a sales incentive basis your achievement of targets. So in your offer letter, it would merely be mentioned that your sales incentive would be X percentage of the sales you have achieved, or if you're achieving greater than this amount of sales, you would be entitled to X percentage. If you're achieving greater than Y amount of sales, you would be entitled to Z percentage. So you might also have slabs for the sales incentive, or you might have a fixed percentage basis the sales you have achieved. So these components might not be usually routed through the offer letter. So you cannot trace the number. Like let's say in your gross pay, your sales incentive is rupees 100. You will not be able to find the exact rupees 100 mentioned in your offer letter. So for these items, you will have to do a separate testing. Like you will have to say, let us say the sales commission is like 10% of the sales that the employee has brought into the company. So you have to go and see whether the employee A has brought in rupees 1000 of sales to the company, because 1000 into 10% would yield a sales incentive of rupees 100. So you will have to do some separate testing for these components. Another example would be overtime. So you might have specific rates for overtime, and in the offer letter only the rates would be mentioned, and it would be said that the amount would be dispersed to the employee basis the hours worked and the terms and conditions further set apart. So in such a case, you will not be able to match pi to pi with the offer letter. So you will have to do some workings there to arrive at the amount and ensure whether it is not materially misstated. So I hope you understood this. Like that is what I intend to say when I say that separate validation is required for certain components. And next important thing which you have to ensure is, for the cases where the F&F for the deleted employees, you have to see if the F&F is subsequently getting paid on a sample basis. So what do I mean here? So let us say an employee leaves in the month of May. So what would happen is the F&F would not obviously be getting processed on the day when he leaves. Like let's say he leaves on May 25, the payment would not be disbursed to him on May 25. The payment might be disbursed to him on a later date. So in such a case, you actually have to check whether the payment has actually gone out to the employee. And if the payment has actually not gone out, you need to understand the reasons from the company as to why it is not actually gone out. So that is something again important you need to check to ensure that that the employee is actually left the company and the employee is actually consenting to something. Because what might happen is, let's say the employee does not agree with the amount of F&F that is ultimately getting processed to him, the F&F would not be get dispersed to him, and the employee might also file a suit in some case saying that, boss, whatever you're saying as an F&F amount is not in line with what I'm actually agreeing to, so I am going to file a suit on you. So if the employee ends up filing a suit on the company after leaving the company, it might be a case of a civil litigation, and you need to again assess the impact of the litigation on the financial statement. So it could be something small could lead to something massive. So you just need to keep every single minute detail into account so that you don't miss anything big in the future. So that is one thing I just wanted to iterate. So next we are coming to PF. So we saw the categories for classification in the financials. So PF has two legs, guys. One is the employer contribution, the other is the employee contribution. So your employer contribution would be shown under contribution to provident fund and other funds, and your employee contribution would be a deduction from gross pay. I think I already gave a example for deduction from gross pay, how it would get accounted. I showed you the accounting entry, and I think in case you're not able to recollect that, you could just visit the part 1 of the audit practically series in relation to payroll, and I think you'll get gold clarity for sure. Yeah. So just coming to the next part of it. So the company has to contribute your 12% of basic plus DA for employees having salary less than 15,000. So, but what has happened is there was a historic Supreme Court judgment called the Vivekananda Vidya Mandir case, wherein it was held that the 12% for the computation of the PF contribution had to be applied on your all your fixed allowances except your HRA. So if an allowance is given, so what is a fixed allowance basically? So if an allowance is given to all employees regardless of their class, regardless of their performance, then it is a fixed allowance. So in such a case, you have to apply the 12% on all the fixed allowances excluding HRA. So what you can do is you can check this on a sample basis for the employees. You can take certain number of employees in the company. You can check if the 12% has actually been applied on all the allowances. So some companies might actually even have a more conservative PF policy. Like let's say the company actually, when you compute the 12%, it only comes to 100 and the company has contributed 110. That is perfectly fine. Like if the company is contributing more, that's perfectly fine. However, if the company is contributed less, you need to understand the reason for it, and it might also trigger a reporting implication, which I'll just discuss later on in this video. So yeah. So basically what you have to do is you have to match 4 things here. You have to reconcile 4 things, which I'll just say now. So you have to tie out the employee contribution as per your PF challans to your pay register deduction. So as I told in the previous video also, your employee contribution is basically a recovery from your gross pay. So it will be appearing in the deduction column of your pay register. So you need to match this with your challans amount and with the deduction column of your pay register. I hope you understood the first part. Second part, so your employer contribution is something which the company is bearing out of its own pocket. So your employer contribution as per your challans has to match with the GL code that is actually grouped under your contribution to PF and other codes. So I've again discussed about the concept of grouping, subgrouping and lead in the first part of the Audit Practically series in OPEX. So in case you do not understand that here, you can probably go to the first video, revisit that and come back here. You will have immense clarity once you do that. That is for sure. And next, if I come to the employee, so next what you have to do is, so for your PF, the due date is basically the 15th of the subsequent month. So if you come to the financial year end, that is the month of March, so your contribution for the month of March would not get remitted on 31st of March. So it would be an outstanding amount in the books of accounts of the entity. So it has to be remitted on or before April 15th. So it would be appearing as a liability in your balance sheet. So what you have to do as an auditor is, you have to basically see how much is the employee contribution for the month of March, how much is the employer's contribution for the month of March, and tie it back to the amount that is mentioned as liability in your GL codes. So where will this liability be grouped in the Schedule 3 financials? So this will be grouped under your statutory dues in your other current liabilities. I hope you understood the grouping for this also in your financials. I think that is clear. So next, coming to professional tax. So in professional tax, there is no concept of employer contribution, guys. So basically, if I have to give you a perspective, what do you have to tie back? So basically, we saw 1 and 3 here. So basically, what you need to just ensure is, you need to just ensure that the employee contribution is matching to the pay register deduction. And next, you have to ensure that your employee contribution is matching to your March month liability, because again, for professional tax, the due date is not on the same day of on 31st of March. But there is just one exception. For your Tamil Nadu location, there are 2 due dates. So basically, for April to September period of the year, the last date for the remittance of professional tax to the local authorities is 30th of September. While for your October to March period, the last date for remittance is 31st of March. So let us say your company is registered only in Tamil Nadu. Ideally on March 31, you should not be having a professional tax liability at all in your books, because it ideally has to be remitted by March 31, because March 31 is the last date for remittance. And in case it is not remitted on March 31, assuming that your company only has a unit in Tamil Nadu, it would trigger reporting in Caro Clause 7 for delay in remittance of statutory dues. And next, so there are other states also. For example, if you take Karnataka, the due date is 15th of the subsequent month, similar to PF. For Andhra Pradesh, also it is 15th of the subsequent month, similar to PF. I hope you understood this part, guys. So next, if I just come to ESI and NPS. So ESI, your employer's contribution is 3.25% of your basic, and your employee contribution is 0.75% of your basic. Again, you can do that recomputation on a sample basis for the employees and take a comfort that everything is perfectly fine. And again, you can trace your ESI contribution back, and you can trace your ESI contribution back to the ESI challans and ensure that everything is in line. And for your and you can again trace the deduction back to the pay register, and you can do all the reconciliations which I mentioned above for PF. Similar to that, you can do the same. And for your NPS and SAF, it's optional. So for both the employer and employee, it is optional. So both have to contribute an equal amount. That is there. And next, if I just come to the next part, so staff welfare expenses. So as I had told earlier, we had seen, if I just go up a bit, so we saw salary, wages and bonus. We understood what is contribution to provident and other funds. So share-based payments is majorly based on Ind AS 102 as a concept. I think I will do a separate video on that. I don't want to be covering that here and overloading you guys. So the fourth part is staff welfare expenses, to which we have just come right now, which I will be discussing now, just coming down again to bring you to staff welfare expenses. So if I just come to, where is it gone? So staff welfare expenses. So as I was telling in the first video as well, so it majorly comprises of your gifts to employees, your food charges for employees, your other reimbursements for expenditure incurred by employees. So this is just an illustrative list of items that would ideally come under staff welfare expenses. So what are the audit procedures you need to apply here as an auditor? So the first thing is, I think I've told this in my OPEX video as well, so that you have to scan any listing that comes to you. You just to ensure that everything is appropriate, to ensure that there is no excess accrual that is sitting in there. There is no bogus accrual that is just booked in there, because staff welfare is a very, very underrated area which is not like really looked into by auditors. I think it does warrant a decent amount of attention, because all the auditors usually place their focus on something like and operating expenses or your revenue as an FSLI, but they don't pay much attention to staff welfare, and that's where the management gets an opportunity to play with. So I think you just need to pay decent amount of attention here. So first audit procedure, as I said, was you just need to scan the listing. You need to see if there is anything in the nature of operating expenses that is actually sitting in staff welfare. So if something is in the nature of operating expense but is inadvertently booked in staff welfare by the management, you need to tell the management to book that under operating expenses and not staff welfare expenses. I think that is one thing why you need to probably scan the listing. Second, what you need to do is basically you need to see the supportings for the samples you selected. Like every line item in the listing is your sample. I think I discussed this concept again in your OPEX. So you basically need to see your supportings like your invoice, PO, service entry sheet, your agreements if any have been entered into. In case of reimbursement, you just need to see whether the bills have been appropriately submitted, whether the amount that the company has disbursed to the employees is in line with the amount in the bills that is mentioned, and whether the reimbursements are in line with the company policy, and whether the reimbursement has been duly approved by the payroll team or the HR team, whoever is responsible in that particular case, or if the reimbursement also requires an approval from the user department, whether the user department approval has also been obtained. You need to check these cases also with in relation to approvals. And another important thing is, like, let's say the company provides like catering services to employees or food charges to employees. So in such a scenario, what you need to see is you also need to see whether the food service is on a per plate basis. Like, for example, if the cost agreed by the company with the vendor is on a plate to plate basis. So if it's on a plate to plate basis, you need to get details of the service entry sheet, like how many plates have been consumed during the day, and what is the rate per plate that has been agreed. And you can just recompute that, and you can just ensure whether the invoice that the supplier is issued is appropriate to the entity, and whether the entity has duly approved the invoice that the supplier is actually submitted to the entity. So these are some things you can go through, and you can also see whether the rate has been agreed upon in the PO, whether the rate that is actually charged by the supplier is in line with the rate that's been agreed in the PO, and whether there exists no discrepancy between the two. So that is something you can do. And next, if we just come to bonus. So bonus, again, it's something which requires a lot of food for thought. It is something where you really need to apply your mind. Like, it is something which requires you to be very, very skeptical. So just coming to that. So bonus provision is an accounting estimate. That is one very, very big reason why you need to pay attention to it as an auditor. So, and you need to assess the reasonableness of it in the books of accounts. So what is the payment of bonus act says? Again, bonus is governed by the payment of bonus act. So if the employee's gross salary or earning is less than 21,000, they are eligible for bonus. Perfect. So we've understood that the employees are eligible for bonus, but now many of you might be having a question as to what is the amount of bonus they are eligible for. So for that, we need to divide it into two branches. So if your basic plus DA is less than 7,000, then the bonus is calculated on the actual amount. Let's say the basic plus DA comes out to 5,000 or maybe 6,000 for the employee. So you need to calculate 6,000 into 8.33%, because the minimum rate specified in the act is 8.33%, and it can go anywhere up to 20%, which is the maximum rate. And if your basic plus DA is let's say greater than 7,000, so you have to apply the 8.33% or the 20%, or a rate between 8.33 and 20 on the 7,000. So that is the logic. I think I've just given it here, just pausing for a second so that you guys can see this. So that is it. And bonus movement and validation of the same. So bonus movement, your opening provision, you will basically trace the opening provision to your previous year work paper, and the GL codes which you've used in the subgrouping, you will trace it back there, so that you get comfort that whatever number has been rolled forward from the previous year is perfectly fine. Next, your provision created for the financial year. So assuming it's financial 23-24, you will assess whether the provision created for financial year 23-24 is reasonable. So I will explain. I will explain this. I will explain whether it's I will explain how do we ensure it is reasonable. Maybe after we do this. Next, your opening provision reversed at the time of payout. This also I'll just explain it below. I have an example for you guys to explain it. And your total payment made. So how do you ensure a total payment made? So your total payment made, you will trace to the bank statement. So sometimes what will happen is the entities sometimes pay bonus as a part of the payroll process itself. Like, let's say your payroll gets processed on 30th of the month, that is maybe on 30th or 31st of the month. Some entities pay it as a part of payroll itself. Sometimes what the entities might do is they might pay it as an off-cycle payment, meaning that it is not getting processed along with payroll. So it might be paid off-cycle. So when it is paid off-cycle, you will have to trace it separately to the bank statement. But when it's paid along with payroll, you don't have any concern, because when you did the net pay tracing, you did, like as I discussed in the first part of the video, you have traced it as a part of that itself, and you don't need to do anything additional in such a scenario. So I hope you guys understood how the tracing of the payment has to happen. And ultimately, your closing provision is grouped under your other financial liabilities. In your other financial liabilities, it will be grouped under your employee benefit payables. So this number will ideally be getting grouped under employee benefit payables, and your employee benefit payables will be presented under your other financial liabilities in your Schedule 3 financials. I hope you got this, guys. So next, I've just asked a question here, how to assess the reasonableness of this. So that is what I'm just going to explain below. And while explaining this, I'll also tell you how to assess whether the accrual is reasonable, whether the bonus provision created during the year is reasonable. And I'll also explain you a practical scenario which we encountered in a particular client of ours. So like let us say, so what you have to do is, like let's say the current financial year is financial year 23-24. So let us say this is the moment which the client has given for financial year 23-24. Like you have to just show it here. So let us say this is the moment that the client is given for financial year 23-24. So as an auditor, assuming that you've audited the last 2 years as well, you will have the bonus moment details for the last 2 years as well. So basically you will take these last 2 years details. So your opening provision is there from the previous year. The provision created during the year, the entry you will be passing is your bonus expense account debit to bonus provision. And for a reversal of opening at the time of payout, you will be passing the entry as bonus provision account debit to bonus expense, because you would have created the provision in the previous years. And since you know that for a fact that you're, like let's say 23-24 here, you know for a fact that your opening provision is 1945, but what is ultimately getting paid out is only 1574. So to the extent of 371, it is not getting paid out. And since it pertains to the earlier years, it has to be reversed, which is what we are doing here in relation to the 371. And for the payout which is made, you will simply pass the entry bonus provision account debit to bank. That is for the 1574 here. So this is how you will derive the number. So how do you assess the reasonableness case? So this movement your client will basically be giving you. So what I've just done below is, I'm just saying what is the percentage of the opening provision that is getting paid out. So how do I calculate that? For financial year 23-24, my closing provision so my payout I know is rupees 1574. And I know that my opening provision is 1945. I'm doing 1574 by 1945. I'm getting 81%. For 22-23, I know it's 1157 that's got paid out. I know my opening is 1920. I'm getting 60%. So why do we do it as a percentage of opening? Because your payout that happens during the current year is happening from your opening. So your opening is the source of funds for your payout, which is why you're assessing how much of your opening provision is getting paid out. Because that is ideally the percentage of provision that should be carried in your books. Similarly, I do this for 21-22. So I get to understand that 81% was the average payout here, 60%, 58%. So if I take all the 3 years together, I have an average payout of 67%. Now, if I come to the average closing provision, I am able to see that the average closing provision is around 1880. So that is what I'm able to derive here. And my average payout average provision that should be created in the current year is basically my average payout that is happening into my average closing provision, because ideally I should be creating a provision on an average basis of what I'm actually going to pay out on an average of the provision that I'm carrying in my books throughout all the 3 years. So this concept is called as look back, LOOKBACK. So this is something we do as auditors to assess the reasonableness of the closing balance. And so I am able to see here that ideally only 1251 should be the number I'm getting when I'm doing 1880 into 67%. But I'm actually having 1776. So I'll tell the management, sir, you should ideally be carrying a provision of 1251 in your books, but you're actually carrying a provision of 1776. So you have to reverse to the extent of 524, sir. So this is what I'll be telling the management, guys. And I've explained the testing, what you would be doing for the payout. So for the provision created during the year, what you would be basically doing is management will have an employee-wise listing of provision created during the year. So you will get that listing from them. You will basically see the employee's performance during the last 1 year or last 2 years and see how much is the provision how much is the bonus that's been usually paid out to him basis his performance. And then you'll estimate, like let's say the employee can get a maximum of rupees 100 as bonus, and let's say he's achieved a rating of like let's say 1 is the highest rating, and 5 is the lowest. So let's say he's got a rating of 2 in the last 2 years maybe. So let's say he got a payout of 90 in the last year and he got a payout of maybe 80 in the last year. So in such a scenario, the average provision that should be accrued for him is ideally 85. So on an employee to employee basis, you can do this recomputation. You can see whether the 100 which they have initially taken for the computation is actually in line with the offer letter or in line with the salary escalation letter which is mentioned. So that is something you can first do, and you can then apply a percentage or take an average of what's been his usual trend in the past, and then see if that's been appropriately included in the computation. So this is about it. So next, if I just come to the reporting implications in relation to payroll, just give me a moment, guys. I'll just come to that. Yeah, guys. So I'm just coming to the reporting implications in relation to payroll. So all the reporting implications are majorly in relation to Caro, except one which forms the part of your main audit report, which I'll be discussing separately. I'll just be giving you a gist of it, but we'll just take that up separately. So first one is in relation to your employee advances. So this is discussed in clause 3. So what we have to do is we have to report the employee advances number as a part of clause 3. So since we are reporting this number in the Caro 2020 report, we need to have comfort over this number. So because if we don't have comfort over the number, how will the users even get comfort over the number? Because you're the primary person. When you yourself don't have that comfort, how will a third person to this financial statements get comfort on it? Logical, right? Yeah. So then usually your employee advances are recorded via pay register as a deduction. Like I told you that this is also one of your components of deduction. So if you have to tell you the scheme of entries, let's say gross pay for the employee is rupees 100. Let's say a loan is given to the employee. What entry will you pass? You will pass the entry advance account debit to bank. Then while recovering the loan, you will pass the entry salary, wages, bonus account debit. And let's say yes, the net pay for the employee is rupees 80, assuming that this is the only component of deduction that is there. You will pass the entry salaries, wages, and bonus account debit 100 to advance 20, which is the deduction, to bank 80, which will be your net pay amount. So how will you test the advances? How will you get comfort on the number? So your opening advances, you will basically be tracing it to the previous year work paper, like similar to how we did for bonus. Your advances granted during the year, you will get the listing from the management. You will take samples. You will trace the amount that has been given as advances back to the bank statement as to whether the amount has actually been debited in the entity's bank statement. Then you will see the recovery number. So you will trace the recovery number to the deduction column of the pay register. And again, for your closing advances, you can again trace them to the trace it back to the closing listing, and you can trace it back to the bank statement and the email approvals to get a comfort. So this is how you will usually plot a movement for your employee advances. So I've taken a sample Caro report for an example of how the employee advances have been reported. So like if you just see here, the others which is here is basically advances in the nature of loans. So if I just read here, the aggregate amount during the year and balance outstanding with respect to such guarantee to subsidiary. So that is not of relevance here. We'll take that up separately. And advances in the nature of loans to other parties as per the table given below. So this advance in the nature of loans is in relation to employees. So which is what has been disclosed here, saying this was the amount that was given during the year, the 167, and the 170 is the balance outstanding as at the year end, which is basically the closing advance number here. And the advance granted during the year number is the 167, which we are seeing here. And this is the 170, which they are talking about. And if I just come down, so there are other aspects which we need to see whether it is prejudicial to the company's interest, whether the parties are paying as per the schedule, like whether the recovery is happening as per the schedule as a part of the pay. Like let's say if the advance is for, like let's say if 60 has been given and let's say 10 has to be recovered every month, you have to see whether the 10 is getting recovered as a part of deduction, as a part of the payroll. And if it's not getting recovered, then you need to give an adverse comment in Caro. And in respect of loans and advances in the nature of loans, there is no amount which is overdue for more than 90 days. Ideally, there would not be anything because it is getting recovered as a part of your payroll deduction. So 99.9% of the cases, it won't be there unless it's a separate recovery of payroll. So that is one thing. And next, you have to see whether whether the schedule for payment, and payment of principal and interest has been stipulated. Yes, it's obviously stipulated. It will definitely be stipulated as a part of the HR policy or the agreement with the employee. You can just check that. And you have to see whether there is no renewal or no fresh loan that has been granted to repay that. That ideally would not be happening because it is anyway getting recovered through payroll, but you just need to check once whether there is anything of that sort that's actually happening. So then then you have to check whether the advances in the nature of loans had stipulated the scheduled repayment. So you have to see whether there's a schedule for repayment and that it's not getting recovered on demand. So usually that won't be the case with companies. So you don't really need to like bang your head on this, or you don't need to really overthink about this. This usually won't be an issue in relation to employee advances because mostly they get recovered via payroll. So you don't need to really break your head over this. But anyways, you can just do a sense check to see if everything is perfectly fine. Next, we just come to your clause 7 Caro reporting stat dues. So clause 7 here requires to report stat dues that are outstanding as on March 31 for a period of greater than 6 months from the date on which they become payable. You didn't understand anything, right? I'm sure you didn't. So I'll just explain this. So basically what it is telling us to report is that, let's say March 31st is the year end date. It is asking us, sir, is there any due that is outstanding for a period of greater than 6 months from the date on which they become payable? So again, I will just take an example to explain this. So let's say there is a PF due. let's say if there is a non-deposit for the month of September, like let's say the due date for September is October 15th, which I just explained to you guys a few minutes back. So you guys tell me, so the due date is October 15th and it has not been deposited on March 31. Will this trigger a reporting in clause 7A? No guys, it will not trigger a reporting in clause 7A because it is telling us to report only those dues that are outstanding for a period greater than 6 months from the date on which they become payable. So in this case, if you just see, so November, December. So November, December, Jan, Feb, March. It's not 6 months. So let's say maybe let's take maybe the example of August as a month. So for August, the due date would be September 15th. So if you take September 15th into account, what would be the months for its which it's due for which it's due? So zero point 0.5 months of September, your October, November, December, Jan, Feb, March. So it will be due for 6.5 months. So if the dues for the month of August had not been deposited, then it would have triggered a reporting in clause 7. Another case where your payroll dues would be triggered for reporting under clause 7 is whether there is any delay in the default deposit of material dues. Like for example, I was telling you guys about the example of your professional tax. If the professional tax has not been deposited within the due date, or if your PF has not been deposited within the due date, or if your ESA has not been deposited within the due date specified in the statute, again that would be reported under clause 7. So that is, these are some things which would be reporting again. So that is also a clause 7 reporting that would be triggered. So this is a case which you usually would not see in clients. This is usually a very one-off case, like where there is a mismatch in the UAN details. In such a scenario, this would be an issue that is occurring. But again, the possibility of that exceeding 6 months is highly unlikely because the default would usually get remedied within the year. But again, we just need to check this as an auditor and we need to report this if there is anything of such sorts. So again, coming to managerial remuneration, we just need to check whether it's within limits and we need to report this as a part of our main audit report saying that it is within the limit set under section 197. And I will discuss on this in a detailed video on managerial remuneration, on how we do the computation, what is the logic for the computation, all that stuff. Guys, I hope you found this insightful. Thank you so much. Keep learning, keep growing. Do share the channel if you found this insightful. More better content is on its way. Keep learning, stay tuned to the channel, and keep subscribed to the channel. Thank you so much, guys. Always be supportive. Always be supportive. Thank you so much. Keep learning, keep growing. Thank you.